you look at the markets, a hint of recovery now coming in, 48 points just in terms of decline, 8,187. For a split second, we went down about 100 odd points, but now we've recovered 50 points from that low. But still, one would say that negativity, the trend on the lower side is something which is continuing, as Jakes was pointing out, a 25-30 point decline. In the morning, towards the opening, it went down to as low as 18 odd points. But then, if you look at the markets right now, it's essentially down about 0.5% odd. Broader markets started off well, but in start you generally don't get an indication of what is really happening over there. But still, continuing to be strong. So, a mid-cap index is up 0.5%, close to about 0.3%. Small cap index is up 0.1%. Nifty Junior, the second biggest after Nifty, is up about 0.5% or so. So it's looking good as far as the broader markets is concerned. Probably the DII side of the market seems to be buying decently. Advance decline, absolutely same, 225 advances to 226 declines as far as BSE 500 is concerned. So that tells you that it's not an all-out selling sort of a day. It's essentially a day where some sort of buying activity is taking place in the broader market. Stock-specific action, of course, continues in the large cap space. Lupin is down about 4%. It was down 4% yesterday as well. Results were poor, and that led to an 8% decline. Infosys is now down 1.6. Kotak Bank is down a full 1.4% as of now, 1,321. Tech Mahindra down 1.4, HDFC down 1.3, HDFC Bank down about 1.3%. These are the losers. The gainers, Cipla 2.5% higher. I think that shift from Lupin to Cipla, that's what the street is focusing in on. Asian Paints up 2%, Bajaj Auto up 1.6 to 2,160 as far as Bajaj Auto is concerned, 1.6% on the higher side. Not much that we can see into the gainers compared to losers. Sunil Subramaniam, Deputy CEO at Sundaram Mutual Fund, now joins in. Sunil, if you could start with the markets after the correction, are the Indian markets looking in healthy?
Absolutely. I think the recent correction, which is more of a news flow and liquidity driven correction, right, is a very good news for the Indian markets from its relative attractiveness to the other emerging economies. So I think that this kind of a bull run where there's a pause and a breathing, gaining some kind of a breath and then rising is always good for the long-term investor, because when people allocate money, let's say in mutual funds through SIPs, and they're putting their money in every month, right? If you're in a continuously rising market, then it kind of hurts you because you're going on buying at higher prices. But such corrections help them to average out their acquisition cost, and hence such corrections are excellent from a long-term retail investor perspective.
Right, but in bull markets, the correction can be sharp. I mean, we've seen 15-odd%. Do you think it can go till 20-25% as well?
No, these numbers of 15% or 20% are essentially a function of the Sensex. So if you look at the core economy, look at the mid-cap, the BSE 500 indices, there you won't see such kind of sharp correction, because it's, corrections are what? News flow driven, liquidity driven, and then if earnings don't live up to the expectations, right? So when you have a broader market space, there'll always be companies which are doing well, where you can pick up those stocks. So I think if you look at us from a stock picking broader market perspective, such corrections will not be so deep. But at a Nifty, Sensex, large cap, where you have news flows and things, you can get 20-25% corrections in specific sectors which have been overbought or something like that.
Right, but in a bull market, always the argument would continue that this is the top, investors are estimating too much. But is that something which will always continue?
Yes, I think that given the fact that in the world economy today, you have a sharp polarization between Europe and the US in terms of what the economy expectations are, and there is money, liquidity flowing in from both sides of sector. So if there's a rate hike in the US, you see money withdrawing, there will be a correction, right? But at the same time, if Europe news is not good, they're going to pump more QE in. That will balance it out. So you are definitely going to see this volatility continue for the next few months.
Right. How a fund like you takes advantage of this volatility?
See, one of the key elements here is that as a fund, there's two elements to it, right? As an investment philosophy and a marketing philosophy. So on the marketing side, our main focus is to get long-term money into the funds. And what we do is we pitch core growth economy funds. So if you look at funds like Midcap, Smile, which are the smaller mid-cap, because we believe that the core economy story for India is very sound. There could be initial hitches in terms of getting project approvals. The government doesn't have a political authority yet to pass Rajya Sabha bills. But over a longer term, definitely this will come and help Indian GDP grow. So getting in money in those kind of funds is a key element of the marketing activity, and when you see 60 to 70% of our flows are in the mid and small cap segments. So as a result of those flows, what advantage we get is that we frequently have cash balances on a short term. So whenever there are corrections, it's easy to allocate and buy for the long-term investor cash. So as a fund house, we don't believe in keeping cash. We believe that decision is not done by the AMC. AMC has been given the power to manage funds in the equity markets. But when you get flows in, which is what we are saying, for example, this year our run rate of flows is already double of last year in our open-ended schemes. These flows help us to use these corrections to smart advantage and buy those sectors and those stocks where we feel the long-term story is very good. And stock picking is the key here. So I think such corrections are excellent from a fund house like ours, which is a very retail and a mid and small cap oriented fund house. So we are looking at this in a very positive way.
Right. Recently, we interviewed the CEO of Reliance Mutual Fund, and he told us that they are seeing a substantial change as far as their retail investors are concerned. The way in which they are investing, the way in which they are going ahead and coming up with their SIPs or savings has substantially changed, and they don't expect that if the markets go down substantially from here on, still the retail flows or the SIP flows, according to them, would continue. Do you agree with the same?
Yeah, I think yes. I'm in agreement for 2-3 reasons. One is, if you look at the SIP book, right, we have seen a 50% growth in our SIP book year on year. So which means today that much extra money is coming in on a regular basis. Now if customer signs up for it, so the average SIP period they sign up for is 3.5 years, right? So very few customers actually go and change their mind about SIP and stop an SIP when the market corrects. So getting regular flows through SIPs is one key change which has happened in the retail segment. Second thing is that, see, retail investors are always people who don't catch the first wave of the rise. But when they then see that the rise has some substantial impact, and this is here that the political change has also helped the retail people get confidence about the Indian economy. Revival in equities as an asset class in retail has started to widen now. So I think that is a very healthy sign, and so the next few corrections are unlikely to see. For example, if you see our redemption have halved over the previous year. So people are not now booking profits at every rise, and and kind of like, so I think the long-term approach of the retail investor, the re-confidence in the Indian capital markets is coming back. And second thing is the shift from retail monies in the last 3 years were going into gold, were going into real estate in a lot of way. And I think the underperformance of those sectors combined with the good performance of the equity markets has made them realize that having this kind of a paper asset class of equities which is correlated with the Indian economy is a good thing to do. So there is a shift in the retail investors' thought process, which is very, very good from their own perspective. Just because if you give a sense of this, right, if you look at a 3-year perspective, retail investors coming into mid and small cap funds have made something like 30% returns, right? So if you look at it from compared to an FD, which is what he compares, he's looking at a very positive kind of a post-purchase, approach today, and that is changing his behavior.
Right. Sunil, if we look at the argument that has always been there, at least in the last 7-8 years, has been that if FII starts selling, who would actually invest? Do you think the mutual fund industry, say if we see such high growth continuing, say for the next 1 year or so, can match that dollar to dollar buying to selling, or mutual fund industry being so big that they can match up if there is any big selling coming in from FIIs?
So there are two aspects to this. One aspect is that mutual fund gets money across a range of sectors. Right? You get money in small cap funds, micro cap. Last time we raised about 1,000 crores through small and micro cap funds. So countering an FII who's largely in the large cap space, right, is not entirely one-to-one possible by a mutual fund, because mutual fund money comes across a range of sectors, where FI money is focused on the large cap and the large mid cap space. So mutual funds can, through their buying action, make the broader market more protected from these kind of flows. But at a Nifty and a large cap, there's a limited viability with them, because only domestic institutions like an LIC or somebody else can actually counter those. Mutual fund industry will essentially have to buy a broader market play.
Right. Sunil, just stay on with us. UFO is the big listing that's happening today. It's a media company or a media sector-based company, and about 600 crores is what they've raised. The pre-open pricing was about 4% on the lower side, but as I can see the current ticks on my screen, 617 odd levels, 1% decline. 625 was the issue price, 10 rupees lower. Probably, one would say that the response was not that great as one would have thought. Just about 2 times, 3 times is what they got. Some of the recent IPOs that we've seen off late have got about 4-5 times in terms of an issuance, largely an issue response. But this one, 4% was what was indicated. It started at 615, 618, but now is coming in close to about 607, 8 odd levels. We'll be talking to the management just in a short while from now. You just saw them ringing the bell. Now they can give a guidance for the company, but before the issue got listed, they could not give a guidance. So we'll try and get across some sort of growth perspective coming in from the company, but overall it's a media space company, it's a new age company. They have monopolistic sort of market share within the digital media space. Essentially what it does is that if you are a PVR or an Inox or any other theater, then they would give you digital print based via satellite. So you don't need the prints, you just get a digital print coming in from them, and that is done via a satellite base. So irrespective of where you are, if you have that digital machine, you can contact UFO Movies and screen that particular movie. So that's a new age business that that has got listed. 600 crores is what they have raised. It's a PE investors who are exiting. It's not particularly anything that the company has raised. Volumes, of course, on the listing day seem to be quite high. Sunil, talking about IPOs, issuances, offer for sale, how big a risk is that for liquidity in the market? We've seen huge issues coming in the last 6 months. Coal India was a very big issue. Sun Pharma block that was there on the grab was a very big issue. You think that such issues, or the market has the liquidity to absorb such high and big deals? Absolutely,
because equities is still an under-owned asset class in India, and as we talked about a few minutes ago about retail flows starting to come back, so retail flows can also come into the direct equities as well as into mutual funds. So I think that as the increasing shift from physical assets to financial assets is taking place, as equities becomes more owned, the depth of the Indian market is going to dramatically improve. So I think what we are talking about in terms of today, the markets are very shallow because there's so much news flow involved in it in the large cap space, but Indian markets have the capacity to absorb phenomenally larger amounts of fresh IPOs than what's currently there. So that's not at all a worry from a longer term perspective.
Right, but don't you think that in near term such big issues limit the sort of investment that anybody can make? I mean, Sun Pharma was as big as Coal India in terms of an IPO. So don't you think that there is something that one needs to be worried about in terms of very large issuances coming in?
No, not really, because I think that this is also the right time for companies to tap the capital markets, right? Because we view equities as something that's going to give a 15 to 20% CAGR. So if a company is going to postpone its issuances, see, companies raise money basically to invest in fresh capacity. And then capacity creation and the disintermediation of going directly to the investor is a healthy trend. And I think as more such companies come in, you will see a win-win effect. The people will also see IPOs are a key element of where people can go and get a little bit underpriced assets compared to buying them off the secondary market. So we are not unduly concerned about this trend or the ability of the market to absorb such issuances.
Right. So you've spoken about liquidity, and you're not particularly worried about the liquidity side of the market. It will come in. The other side of the market is the government, and what we have seen. They are just about to complete 1 year in terms of their entire tenure. Some would say that it's slightly lower than estimates or slightly behind what the street was estimating. How would you say? You think that there are a lot of good things which are done? How would you rate it? Or the markets was estimating just too much out of them?
I think it's a combination of both things that you said. So if you put things into a quadrant, right, and say that there are urgent things to be done and there are important things to be done, right? So I think the important and the urgent part, and then the important non-urgent parts. I think what the government has done is the non-urgent important, they've done a lot of hard work on, which is not visible. But I think where they have not been able to do is the urgent important thing which the market is expecting. So the market expected that there's a magic wand and this government will be able to do a lot of things. But I think the ground reality, if you look at it, the fact that they don't have a political majority in the Rajya Sabha, the fact that they don't control a lot of the states, so implementation of projects is going to take time. The fact that there are politically sensitive issues like land reforms which need to be conveyed to the, largely the voting class. So it's a very dicey thing to that while the government we believe is strongly pro-economy, pro-growth, and they're doing all the right long-term things. I think in the short term is where there has been a gap between expectation and their response in terms of what was expected. Big bang announcements haven't happened, and even corporate India is getting a little bit disillusioned because they were expecting stronger cuts in interest rates already to be in place, stronger visibility statements to be made saying dramatically this is happening. But that, I think you have to give the benefit of the doubt to the government, that there is always that if they make those statements, then there will be disillusionment because they know they can't live up to that. So the way the government is going about, which is one, there is a delinking between the political part of the government. I think Mr. Amit Shah and his team are taking care of the political, whereas Modi is clearly focusing on the economy. Second, this Make in India, while that was a big bang statement, It needs time. And you see Mr. Modi, and he's been called the non-resident prime minister in a jocular sense by the opposition, but it's very, very critical, because unless you are able to go and do a PR work with the countries to say that India ground level is changed, please come and invest in India. So this is the important non-urgent work which Mr. Modi and his team are focusing on. These are going to definitely pay off in terms of increased FDI, investments in India, shifting a lot of imports from being now made in India over the next 18 to 24 months. So I think there is need a little bit of patience in terms of sticking with the government and their processes and what policies they announce, and we are confident that in a 24 to 36 month time frame we will definitely see our economy coming up to a double-digit GDP growth rates and a future which is very, very rosy. But I think this is an initial period. You cannot satisfy all aspects of the economy in terms of different people having different needs.
Right.
Farmers are worried about MSP, they are not worried about GDP. So, political opposition is always looking for a gap to which to exploit. So this is the healthiness of a democracy, right? If it was a dictatorship, then there will be silencing all the detractors and then going ahead. We are in a democracy, so I think this kind of a dissent and this kind of a thing is something which will happen. And from a mutual fund representative of the mutual fund investor, these are the ideal things which give you a buying opportunity, because everything is rosy and everybody believes that everything is rosy, then markets are going to discount the future and all going to be lifetime highs. Right. And the retail investor will miss out in terms of coming in. So this is a good healthy mix. We have not lost confidence in the Modi government, because we strongly believe that they have the right things on their agenda, like GST, land reforms. They are focusing on the right thing, FDI in insurance, FDI in multi-brand retail.
Correct.
So they are doing the right things, but the pace of growth is not as expected by the markets and the key the industrial players. So that is the current thing, but that's only a buying opportunity. We definitely believe that the corrections in the market are an opportunity. The fact that currency spiked up, interest rates, bond markets collapsed, means that an interest rate cut now looks more possible. So that's an asset class which will ultimately help the equities also. So this is a good pause moment, but a good long-term buying moment for everybody, I think.
Right. What do you make of the results season so far? We can only stick to the large cap at this point of time. What do you think about it? Do you think downgrades are likely, or it's broadly in line? It's
been a mixed bag in terms of results, but what we are happy about is the results on the banking sector. The private banks have done a very good result posting. The PSU banks also, the NPA situations are all not as thick. So I think that banks are core economy. So if you ask from a results perspective, it is the banking results which are a harbinger, which explain, because banks ultimately are dealing with the customer. Banks doing well means India is doing well. So I think that if you take out of the mixed bag of results, the positive side on the banking side is a very good thing from a long-term economy perspective.
Right. What would you make of pharma and IT? Two names that have done very well in the last 5 years in terms of numbers I'm talking about. Generally a company like Lupin, generally a company like TCS never disappoints, HCL Tech never disappoints, but that has happened this time. You think that polarized nature of earnings is now translating into a broad-based earnings growth, where polarized companies which had high base will not do well and companies which have low base will start to look quite good?
Absolutely. I think that's the normal phase of the markets, right? You always have something which is overhyped, then it doesn't come, it comes correct. That's the cycle of thing. So I think if you look at it from a perspective of the large caps, for example, there will always be a sharp polarization, because people like favorites. People like to bet on certain groups and certain companies. And in fact, there is one of our funds called a multiplier fund, which is actually playing out this strategy. What it's doing is doing the large caps, it's going and doing contra bets in the large cap, right? So it bought Infosys when it was out of favor, it bought Tata Motors. So, and then on the small and mid cap, it's a multi-cap fund, it's going for MNC names which are more safety oriented. So if you look at it, what you are saying is exactly the opportunity which represents from the market, that in the large cap there's a sharp polarization. And with a long-term approach, you can always make money, because ultimately if you see all of these players, one quarter one will win, another quarter another will win. So you can't say that this company is bad, that company is good. It is only about market hype, market expectations. And if you stick to the core fundamentals of these large cap, the names that you mentioned, right, there's nothing to worry about, right? It's just that market has a consensus estimate based on outside information. Company always has an inside better information, and so the guidance they give, people attach importance to these things, but the core fundamentals of these companies are not dramatically altered.
Right, and let's now go to the broader universe. The correction that we've seen in Nifty and Sensex has been way higher from the highs, but the mid-cap space have continued to see some sort of buying coming in at every lower level. So they correct 3, 4, 5% and you see a good amount of buying coming in. So far the numbers that we've got in the mid-cap space, are you decently satisfied by the numbers overall?
Yes, we are very decently satisfied by the mid-cap space, and in the mid-cap, the index is not a real good harbinger. For example, it is individual stocks because there are far larger number of companies, right? So, and individual stocks there have done very, very well even in this earnings cycle. So, if you look at the kind of returns that mid-caps have given, they are like well ahead of the large caps. Why? Mid-cap funds, for example, are well ahead of the large cap space because specific good quality companies have quarter on quarter been demonstrating very good results, and that's why there's buying in those companies. So we remain very confident on the mid cap space, and if you look at the kind of returns that the mid cap, large cap 1 year is about what, 15%, mid caps is about 32%, our funds are given about 54%. So the alpha that you can generate in mid caps is what gives them that the beauty, right? And over the long term, the first phase that mid caps rose, and this is why the mid cap valuations were closer to large cap, was the catch up in the correction which had happened because people were very negative on mid caps a year ago, 2 years ago. But the next phase of growth is going to come from the superior earnings growth of these companies, right? So while the valuations may be at or close to the large cap of the mid cap index, if you look specific stocks, for example, we did an analysis of our mid cap portfolio, and our own earnings projections for those stocks in our portfolio was 40% CAGR over the next 2 years. So if you're going to even discount that by say 20%, the earnings, naturally the price has to keep pace with the earnings growth. So I think what is happening in the mid-cap space is that we are now into phase 2 of the growth, which is their actual earnings, and these are all economy dependent. So as the economy recovers, you will find that their growth in EPS far outpaces that of a large cap stock. So it's still a good time to buy into mid-cap spaces and earn good returns. For example, a year ago, if you recollect, we had launched our micro-cap series, right? In this time when large cap returned 15%, mid-cap is 32%, our funds gave 50 and 60 in the mid-cap space, the micro-cap has given 95 to 110% return in a year. So if you see that phase of the valuation catch-up has delivered phenomenal returns, but in the next phase, you may not get the same kind of a 90, 40%, but definitely, GDP, inflation plus alpha you can expect from the mid-cap space going forward based on stock selection and stock picking.
Right, Sunil, thank you so much for joining us here this morning. Hope you have a great day going ahead. That was a view coming in from Sundaram Mutual Fund. Let's take a quick break. Markets have actually recovered quite significantly, just down about 30 odd points as far as Nifty is concerned. On the other side of this break, we'll be talking into Shekhar Bajaj, CMD at Bajaj Electrical. We'll be focusing in on the slowdown in the rural economy.